Yeah, just some.
And thank you all who came for the first time today. Glad to have you here. We meet at this time every week, and are, if you guys haven't come before, I'm looking for more people to help facilitate this next year. So please talk to us about it.
All right. Thanks.
And the other thing too, I'm a part owner of the Green Bay Packers. So I own one share. True story. So is the camera rolling?
Yes.
You're getting all this? Okay, so I should be on my best behavior here. Not that that's possible. Let's see.
What is the liquidity like on a Green Bay Packers share?
It's not too much, because I can't sell it. I can only bequeath it to an heir, and it will not appreciate in value. If we win another Super Bowl, that would make it all worthwhile. I'm sorry, I need to load this thing. Remember where I put it. I think it's.
I can get this turned off until you upload if you like.
Oh, that's okay. So.
As while we're getting this set up, I didn't get a chance to hear, how did you guys find out about this, and what do you guys study? What year are you?
we all found out through the page.
Yeah, Facebook page, we've been following the page, and I studied math. I'm a senior student.
Awesome.
And I'm Jay.
Nice to meet you.
Nice to meet you.
I'm Matt. I study GIS.
Awesome.
Senior.
Well, I'm Rock, and I'm studying forestry, and I'm a PhD student.
Awesome.
I'm Andrew. I'm a senior in mathematics as well.
Excellent. Thank you guys for coming.
Thank you for holding.
Professor Hanson, which classes do you teach?
I teach CFRM 506, which is Excel, VBA, SQL, financial data management and access. I teach 2 C++ courses. One's kind of an intro / intermediate, and then an advanced course for quantitative development in C++. And this quarter I'm teaching 524 or 522, which is Introduction to Trading Strategies. And then I also teach 425, which is our programming for finance.
And if any of you guys are interested, Professor Hanson is going to be coming back in on the 22nd.
Yeah, for another talk on C++. So you're not rid of me yet. We'll see how this goes. See if you want to invite me back.
Yeah, absolutely. We already know. So this is more on the math finance side, and that'll be more on the programming side.
Yeah, but I should point out though that I teach programming, but for quants. So we should, if you want just like a minute or two, I can give you a little spiel about it. So I teach them, we care about doubles and ints, that's it. There's a string class, but we just don't care about strings. I mean, we use them for, for outputting things to the screen, but we don't pass around strings because it's numerical programming. And so we don't, a traditional C++ or programming course, we'll probably spend 2 weeks on strings. So we just don't care. And there are other things we just, that are typically, things like search algorithms, sort algorithms, that sort of thing. It's already in the library. So again, it's kind of the mantra for the class is we don't care. because it's there. Why reinvent the wheel? You're not going to learn how to implement a doubly linked list in my class. In fact, we don't. If you're familiar with C++, really the only STL sequential STL container we use is vector. Because there's just no need to use anything else, so we don't spend a lot of time on that. But we do spend a lot of time on STL algorithms, but it's usually with a vector or sometimes a map. That's it. So, and then we code up models and look at ways to do that using object orientation and other methods. But that's for 2 weeks from now. But since we're talking about it.
I have a question. Why do the financial engineering use C++ instead of other languages?
They do use other languages. So right now, Python is extremely hot. R is maybe not as hot as Python now, but it's used a lot. But those two are used for prototyping models. But when performance really counts, then the models are put onto a more robust platform often. I mean, up until about 10, 15 years ago, C++ was it. It's very rare to see any other language. Now it's Java and C# have made inroads, but it depends upon the company. And there's some companies that have made a commitment to C++, even though there's more to it. It's not going to be as easy to implement things as Java or C#, for example. But when you want the speed and the scalability, then C++ usually wins. I'm not knocking the other languages, and I like C# quite a bit. But when you want to get down to bare metal and you want that, a robust platform that's scalable, C++ is usually preferred.
I also want to throw out that we've hosted a number of firms over the last year, and many of them, for example, Acuna that Robbie had mentioned, has teams that work in pretty much every language. They have a Python team, they have a Java team, they have a C# team, they have a C++ team.
Really?
Really depends on what you're doing.
Yeah, and there's that too, yeah.
Right, so most of your low latency market microstructure stuff is going to happen in C++. There are a whole lot of Verilog engineers, for example, too, that work on their own ICs. And then pretty much everything that the quant researchers will do will be in Python.
Yeah, Python or R is used a lot in.
Exactly. But once again, they have heavily optimized libraries internally.
Mm-hmm.
So they have engineers that work in C++ or CPython or Cython to enable all of that.
All right, well, you want to get into the wonderful world of variable annuities? Okay. So I worked in this field for about 5 years. And it's something I had no idea about until I was looking for a new job. And I worked for a global insurance company. I first worked in Japan for I was over there already. So I took the job. I was there for about 9 months and then transferred to Philadelphia, where I spent the rest of my time with the same company. These are products that they have guaranteed investments, so you put your money in like you would, say, a 401k, but it all goes in at once. It's not, monthly. So it all goes in at once, but you have a choice of mutual funds you can choose from. In order to hedge these guarantees, though, takes a lot of traditional quant finance, and then plus there's an insurance component, and that's where the actuaries come in. So I thought it might be interesting to your group because I suspect that probably none of you know about this unless you maybe could have some experience in the actuarial field. But they hire quants, and so it might be an avenue you might want to look at because there are jobs out there and they need good people, and sometimes it's hard to find them.
And if this is of interest to people here,
Yeah.
there's an active actuarial club here too.
Yeah. But
if you guys are involved.
yeah, although I'm getting a little ahead of myself, but okay, is anyone here familiar with the musical Oklahoma? Classic. You know, anyone else? The musical? No. Okay, there's a song in there. It's about how the farmer and the cowboy should be friends because they're always fighting. So, you know, my idea was the actuary and the quant should be friends because there's, you know, a lot of this. Anyway. But I'll tell you a little more about that. All right, so here's some references. I actually worked with a couple of these guys. Frank Jung and where is he? David Schrager. So are you familiar with the book by Brigo and Mercurio for interest rate derivatives? If you want to learn about interest rate derivatives, this is really the go-to book, in my opinion. And then for this topic, for investment guarantees and annuities, this is kind of the definitive book by Mary Hardy. Although she doesn't get into Monte Carlo as much, but these models are usually driven by Monte Carlo.
Really quickly, will you possibly be able to share these slides with us after the presentation?
Sure, yeah.
Perfect. So we'll get them sent out.
Yeah, and I'll just send them to you.
Perfect. Thank you.
Okay. So as an overview, the world's simplest equity guarantee is, say you buy a stock fund and its share price is 100, you hold it for 20 years, and then at the end of that time period, if there's a gain, you just take the gain and you walk away. But if there's a loss, then the issuer makes up the difference. So your capital is guaranteed. So in the insurance world, this is a type of benefit in what's called a variable annuity contract, and it's called a guaranteed minimum accumulation benefit, or GMAB. There are other companies. One I know of is the Man Fund Group, Isle of Man, and they have investments that are guaranteed, but there's no insurance component to it, like you do have with annuities that are sold by insurance companies. And there's a local company here too that does something like that, but I can't remember which one it was. But anyway, graphically, that's what it looks like. So end of 20 years, you're good. Take the money and go buy a new Tesla. However, if you lose money, then the issuer has to make up this amount of money. So, well, what is this? This is basically a 20-year put option. Okay, but you can't buy a 20-year put option in the market. So what the company has to do is to hedge this liability over the life of the contract, and this is where, as you can see, it's a long-term put option, but you have to use the traditional option tools, namely the Greek values and others, to always have an idea of what your liability is. So this is where the need for traditional quants comes in. This is something that usually actuaries, even in the investment track, really do not get much exposure to this area. Okay. So most of the guaranteed products offered through life insurance companies are going to include a death benefit. And so again, in the simplest case, if the contract holder dies before the maturity date, then the insurer is going to make up any net loss at the time of death. And this is called a guaranteed minimum death benefit. And so graphically, if we look at it, suppose the customer dies before the 20 years, so death is here. The option is in the money, so it's at a loss for the policyholder. So the insurance company must make up this difference as well. Okay, so the accumulation benefit is an example of what's called a living benefit as opposed to the death benefit, which is tautologically a death benefit. But there are other types of living benefit types. One is guaranteed minimum income benefit, and this locks in a rate or a minimum rate at which the policyholder can convert the money to an annuity, so a fixed rate annuity. So that can be written into the contract, and that's where the name annuity comes from in variable annuity. You invest the money in the funds, and then at the end you will have the option to take that, say you're at or past retirement, now you need a steady stream of income, you convert it to an annuity. Not everybody does that, but it's for many products it's an option. The other one is a very popular one. It's called guaranteed minimum withdrawal benefit, and what this does is you can keep your money in the market, but again, in retirement you might want to have income, so you can take income or money out of principal at a guaranteed minimum, but still keep your money in the market. So as I said, this is a very popular benefit, and we'll talk about what this means, a benefit base, in a minute. There's a distinction where you'll see in a minute where we have to go from quant finance then into the insurance world, and so we map quant variables to insurance variables, and one of those variables is the benefit base. Okay, so a VA contract, these are sometimes called SPVAs, or just VAs for short. The single premium, meaning you put the money in a lump sum, but then you can put it into a combination of mutual funds. And again, it's like a 401k plan where there will be, certain funds that you're allowed to invest in. So it might be, say, 20 funds, something like that. There may also be, there usually are limitations on your allocation, so on how much you can put into the stock market. So like 60-65% is the typical limit of what you can put in the stock market, and then the rest you put into bond funds. So the policyholder may reallocate percentages in each fund, usually at specified points. Well, I don't know how they are now. Some contracts say you can only make the reallocations at certain dates, but I think some contracts now will let you do it at any time. When I was working on them, there were only specific dates in some of the products where you could reallocate the funds. And then if the policyholder survives to the given contract date, then, as I said, the proceeds can be converted to an annuity for payments over life or over a period certain. And also, these contracts offer local tax advantages in a number of different countries, in that the gains will grow tax-free, but then when you take the money out, it's taxed as regular income. Except, well, if you put the principal you put in is not taxed, any gains on it will be taxed. Okay, so this is, let me do it from here. So, graphically, this is what it looks like, from start to finish. Contract holder puts in a lump benefit. This is the single premium. In some countries, then the commission will just be taken out of this amount. In the U.S., what they do is if you put in, say, $50,000, $50,000 goes in, but you don't see it. How do you say? In Japan, for example, if you put in, say, 5 million yen, then your account value would be 4 million some yen. But in the US, if you put in, say, $50,000, it'll show 50,000, but behind the scenes, then the commissions and fees, the commissions are taken out. So, you know, somebody's got to sell these things, and it is one of the gripes about some of these annuity products is that the insurance salesmen take a big cut off the top. But again, we're in competitive markets, this is kind of changing now. So this is actually from a diagram. This is actually for Japanese products, so they use different notation. Instead of guaranteed minimum, they say minimum guaranteed. So, and SB is survivor benefit. In the US, it's called accumulation benefit. So anyway, so if there's a loss at the end, then the insurance company has to make this up. Or if there's a death, then the insurance company has to make up that loss. And then the contract holder can put this into a regular annuity for regular payments then over time. Yes, sir.
So just to clarify on that, basically like you invest a certain amount of money, the value of it fluctuates, but there's like specific points in time where they may need to like pay out based off, like despite those fluctuations. Or if those events don't trigger, then at the end, they're paid back over time.
Not sure if I understood the question. I mean, let me go the other way and just say, in a simple contract like this, the only time there will be payouts from the insurance company is if there's a death and the option is in the money, the put option. So the account value is less than what was put in originally. Or at the end of the contract, if the value of the investments is less than what the customer put in at the beginning. So those are the only two payouts we're talking about here. There are the living benefits, for example, the withdrawal benefit, and that might be, say, every quarter or every month, a certain percentage can be taken out.
Okay.
Does that make sense?
It does. Could you like re-describe what it needs to be in the money and how a put occurs?
Well, put option is, do you know what a put option is?
It's like a forward, either you're shorting or you're buying.
No, an option means it's, so you can, for example, buy an option on a stock.
Mm-hmm.
Okay, so there's a call option, a put option. A call option means that you'll buy at a certain strike price. So when you buy the contract, there's a strike price associated with the contract. And if you look, if you're trading them, there'll be a whole, like 20, 30 rows of different contracts at different strike prices. So if I buy it now, I buy the option now, and the stock price goes above the stock price goes above the strike, then at maturity, then the payoff is the value of the stock minus the strike price.
Mm-hmm.
So that's how much I earn. A put option is the opposite. It's betting the other way, saying that if I buy a put option, then if the strike or if the stock price is less than the strike at maturity, then I make money. That's in the money.
Okay.
So if there's a payoff, and what I just described to you is the simplest type of option, which is a European option.
Okay.
If you want to learn about options, you can. So, I could come back next year for that one. Because I used to do that for.
Since the Greeks were mentioned, I was going to say, if anyone hasn't taken CFRM 415, you should. It'll teach you about the basics of all of this, options pricing, for European options and also the Greeks.
Are these payout contracts often tagged to inflation rates?
I think there are some products that are linked with inflation rates, yeah. But as I said, that right now is just the world's simplest product to get going.
And then the payout at the end is out of the original, or the ending NAV, right? So let's say that you grew to 120 and then you get a 10% off that 120 for the rest of your life. what happens if you die very early? Does that just, the remainder of that value just go to the provider of this product? Or does that?
It goes to the beneficiary. It's basically a life insurance policy, with the benefit being this difference that the insurance company has to make up. So the beneficiary would get back the principal amount that's in the money that's in the account plus the guarantee.
But if we're like here, right?
Oh,
Already out in your payout period.
Oh, here, this is after the contract. At this point, the variable annuity contract has expired.
Okay.
This is just a regular fixed annuity. So it says it'll be at 5% for 20 years, and you'll get regular monthly payments. Does that make sense?
Yeah.
And that's purchased by the proceeds from the variable annuity contract. Okay. So, so far we've talked about market risk and mortality risk. There's also the risk of lapse and other, what's called policyholder behavior. This is more empirical and statistical. These things need to be estimated. And so what was happening was that with say a simple product like this, if the market went way up, now the contract is way out of the money. So the policyholder could just, if it's past the surrender date, you can't buy it and then a month later surrender, but if you hold it, say, for a period of, say, 3 to 5 years, then you could surrender it. So you cash it in, take the money, buy a new one with a higher guarantee. So in response to this, insurers started providing riders that would increase the benefit base in rising markets. And a couple of examples of this are ratcheting and roll-up. And so if you've had any exposure to options, you may know what a ratchet option is. That's where the strike price ratchets to a new level. And then the other option is a roll-up, which is a guaranteed level increase over the period of the contract. So graphically, they look like this. So this is a ratchet. So the contract might say we'll ratchet every 4 years. So we start here. After 4 years, the market's gone up. Now the new guarantee level is reset here, and likewise here, and so on. Yeah.
I'm sorry, I just want to clarify one point, and I apologize if I'm well behind everybody else, but the policyholder essentially wants the insurer to, sorry, the policyholder actually wants the value of the policy to be less so that their gain is more.
No, the policyholder just wants to make as much money as he can, but wants to be protected from downside risk.
Okay, so any value where the policy value is higher than when it was originally bought, that difference also goes to the policyholder, right?
Yeah, that's your, yeah. If you're the policyholder, yeah, you just take the money and
Okay,
you're good.
But you're hedged against loss, so.
Exactly,
Yeah.
yeah.
Okay.
Yeah.
And
Yeah.
so where is the insurance company making money in this, just other than the fees you mentioned? Are they also taking some percentage of gains? I mean, how does that process?
Well, that's how they take a percentage out of the assets under management, but that goes to fund the quants and the actuaries who hedge these products.
I see, but so nothing is taken from your upside then?
Nothing more than just the fees. It's not like a hedge fund where the hedge fund gets rewarded if it's not. It's the fees are fixed
I see.
or fixed. The rates are fixed.
How do they make money once it turns into a fixed annuity? You have a 10% payout. Do they sell the assets in that annuity?
Well, they'll sell the annuity, and then there are fees associated with the annuity.
Mm-hmm.
So, and they pay the actuaries to come up with those products. There are some companies that will actually, there's some that will allow you to annuitize with another company, But of course, they'll want they'll want your business. But with a lot of products now, you're not locked into buying that fixed annuity with the same company. So whoever issues that annuity then would, again, charges a management fee for all the costs associated with managing the money, the actuarial costs, the regulatory costs, all those things. And then a lot of products now you don't have to convert it to an annuity. You can just take the money, or there are various options for taking your money. Does that make sense? Okay, and then this is the roll up. So instead of just at fixed times, it's just continuously over time. The guarantee is going to go up. So this way, customers have now a disincentive to cash out and buy a new product. It helps in it creates the incentive to just remain with the same policy.
With that one, they take on a lot more market risk, right?
Yeah, both. Yeah. Okay. So that's a good question, because then that's a good segue into the next section. Is in order to hedge the risk, they have to measure the risk, and so they have to calculate the liabilities that are associated with these products. And this is mainly where I worked, was on the liability side. So there's a liability side and then an asset side. The people on the liability side measure the risks, and then on the asset side, they take those results and go into the market and buy futures and possibly options to hedge against the risks that the liability team reports out. So, but both sides have to use a lot of traditional quant finance. So the types of risks that are involved, fund price dynamics, that would get into, if the market tanks. So they have to hedge against what's happening in the markets. Actuarial components, so the risk of death, policyholder behavior, things like lapse, and there can be other statistical policyholder behavior elements that go into these things. And then the liabilities, this would, I guess, kind of tie in with the fund price dynamics, but the accumulation benefit is pretty much tied to this. Sorry, the death benefit is tied to this, as well as the mortality risk, which comes in here with the actuarial components. And then in addition to calculating with liabilities, essentially what you're doing, calculate the liability, is you are calculating the value of an embedded option. It's not a real option, but it's essentially, as I say, it could be a 20-year option. You're measuring the value of that put option. And then along with that put option, then you need to report out the usual sensitivity calculations, or what are called the Greeks, like delta, gamma. So delta, is anyone here not familiar with what I'm talking about?
Yeah.
Okay, so delta is the sensitivity of the price of the option to movements in the underlying asset. So in this case, it would be the change in the value of that option as the values of the investments change. Gamma is the second derivative of that. Vega is the sensitivity with respect to volatility. Rho is the change, or the sensitivity with respect to changes in interest rates. And theta is the change with respect to time. So those all get reported out, and then there are other sensitivity calculations in addition to the traditional ones that need to be reported out. Okay, So fund price dynamics, this is, just comes from traditional Brownian motion. So the stochastic differential equation is, to model stock price movements is, as shown there with where the W term is stochastic. In the Black-Scholes world, we assume fixed interest rates and fixed volatility, but remember, this is over a period of many years, so the interest rates are bound to change, as are the volatilities. So even in the deterministic case, this would be taken from the current term structure of interest rates and this from the current term structure of volatilities. Although this would be a bit trickier because the option is not in the market, but the interest rates, this is taken directly from the market. So this would have to be estimated. This could be taken right from the market. T is in units of year fractions, or years. What we need to do then is to discretize this stochastic differential equation so we can model simulated paths of equity price movements or fund values. Yes?
So is the first part of the equation is the one that drives the price, and the second one is the one that actually represent the fluctuations?
This is the drift term,
Mm.
and this is the randomness, and which is affected by the volatility. So the randomness multiplied by the volatility is going to give you the fluctuations. Now, this is assumed to be in what's called the risk neutral measure, and so because of the theory behind option pricing, it allows us to replace the mean of the mean return of a stock with the risk-free interest rate. You had a question?
Yeah.
Yeah.
The volatility here, how should we think about this? Is it measured from like the overall market, or is it like within that?
Well,
historical
actually,
stock?
I take it back. I made a mistake. The volatility, actually, we can get that from the market. So sorry about that on the recording. That actually is the volatility of whatever. Think of it this way. You're in an annuity and there's one fund and it's an S&P 500 index fund. The volatility would be of the movements of the
It's just the historical variance, something
Mhm.
like that. Okay.
yeah. So I'm sorry I got confused there for a minute about what you can get from the market and what you can't. There's an embedded option, but no, it's not. We're not talking about the like option volatilities in the market. It's the volatility of the underlying stock price. So I apologize for that.
But it's historical.
Yeah, it is, okay, in this case it is, but the reason I got kind of tongue-tied was in the market, if you're just trading options, the volatilities will come across as market data because they're what are called implied volatilities. So they're actually, they're driven by what the market says they are, not by estimating them. So that's the difference. Whereas in this case, you would have to estimate it because you're getting it from the stock price, not from what the market is telling you the volatilities are for the options.
But how do you know that when you don't know the composition of the fund?
We'll get to that. Yeah, there's some approximations that are made, and but that topic alone, that task by itself, usually there will be. I think on our team we had 2 or 3 people devoted just to that problem. I mean, they did other work, but every month they had to report out those values. And so, yeah, you need people dedicated to that task. Okay, so anyway, that's where we're going to start, and then we'll discretize this using one of the usual discretizations. But there are also actuarial components, and this is where I did take in, when I was doing my master's in economics, excuse me, I took some actuarial science courses, and they have this notation which goes back over 100 years, and it's kind of weird. Once you get used to it, it's okay, but when you're first hit with it, if you have a math background, and then you start seeing these symbols, and you're just thinking, what the hell is this? But what this symbol means, it's the probability of surviving, for someone aged X naught, surviving out to time T. It's that probability. So, and then likewise, there's the probability of death over a certain interval. So this says the probability of someone aged X naught dying within 1 year beginning at time T minus 1. So what we'll see is in the Monte Carlo simulation, it will look a lot like quant finance, but then we have to decrement those values by these actuarial values. So it's like taking an expected value based on the probability of survival or the probability of death at a certain point. And then on top of it, there's the decrement of policyholder behavior. So you need to use these when you calculate the present value of each of the simulated paths. But you'll see this in a second. Okay, there is an error here. This arrow should point here, not here. So now, what we have here, this max function, this is the payoff of just a usual put option, where the strike price is the beginning value in the account. So if it goes below that, then the option's in the money, and then there'll be a payoff. The term here, this S capital T, this is the stock price. This is stochastic. And it's capital T because that represents the maturity date. So whatever the stock price at that maturity date is in the future, so we don't know what it's going to be. It's stochastic. But we can simulate these values and then discount them back to the present time by hitting it with the usual discount factor. So this would, without this decrement here, just take this out for a minute, this would be the present value of the payoff from one equity path, where this S and T is randomly generated. But in addition to discounting due to interest rates, you also have to decrement by the probability of staying alive to that point. So cue the Bee Gees here, or you see how many of you got that reference. A few of you. Yeah. Got that on the camera. Yeah.
Question on in terms of taking probabilities into account with returns, is it you always use this as a way to, I guess, like discount something? You discount it using the probability, or do you like calculate the expected return based off the probability distribution and then like take the average?
Oh, for which term? So you have two elements of randomness here. You've got it in the stock price, and you've got it in the probability of survival.
For the probability of survival.
This is determined by actuaries. That's what they do.
Gotcha. So in the actual like return equation, is it a discount rate, or do you?
Yeah, this is the discount rate determined by the market.
Mm-hmm. Okay.
Yeah.
If you have a longer term liability period, how do you determine that discount rate? Do you take an average of every year, or how does?
This is priced off the current term structure.
Oh, I see.
So that's why earlier on I put RFT. It's not constant. That's priced off of the market yield curve. Okay. Cool. So now we get to the discretization of that stochastic differential equation, and without going into the theory, the result is that DW stochastic term can be replaced by the standard normal variate. And actually, this is a mistake here. This should be square root of delta t, I just realized. So I'll have to fix that. But that's what that falls out of the Brownian motion theory, is that dw sub t in the stochastic differential equation, to discretize it and use it with fixed scenario, or with scenarios that are generated, we can replace it by just taking a standard normal variate, just randomly generated, then times the square root of delta t. So over one time step. So what you do is you take the timeline, you chop it up into smaller time steps. That's delta t, and for this case, we're only going out to the terminal point. So the only one that's going to count is S big T, but you'd have to run this out to the end. You'd have to iterate out to the end to get it. Okay. So, but again, these interest rates are not fixed, so we have to price this get this from the current term structure. So this is the forward rate as seen at time 0 over the period t minus 1 to t. So that's taken from, it's just term structure math. And then it's similar for a term structure of volatilities. So one path then, as we saw earlier, its present value is going to be this payoff multiplied by the probability of survival to time t by the discount rate discounting it back to time 0. And then if we do this n times to get the value of this, the liability here, we're going to run n simulations and then take the average. Yeah.
How is there a maximization happening?
No, this is the max operator. So it's the maximum of S naught minus ST in 0 at time capital T. It's like saying what's the max of 2 and 3? It's 3.
Oh, okay, I see.
Yeah, it's a max operator. It's not a. Okay. All right. So now for if we look at this in a more realistic case, what we're going to do is replace S capital T by the account value at time t. So that actually, what we need to do is make the distinction between how much you have in your account and what the benefit base is, because remember the benefit base can change over time. So actually, when you get to to time t, it's actually going to be the benefit base minus your actual value rather than a fixed strike value, which we took earlier just to be the initial equity. So because this can change, as we saw, because you could ratchet, you could have the roll-ups and so forth, we need to actually change this to make this more general. And so what we end up with actually is, and in the previous slide I didn't put in policyholder behavior, that decrement as well. So we just defined GT to be the probability of survival times this policyholder function decrement. And so we just bung it all into G of T and then rewrite now. Our payoff is benefit base minus account value at capital T. And this is, we're going to sum this up now for each scenario I, and then take the average after summing them. Some of these can be zero, but they have to be counted in the average in order to get the correct price. Okay. All right. Now, to calculate delta in the Black-Scholes world, we have nice closed formulae, but when using Monte Carlo, we don't have that luxury, and so you can already see what you'll start seeing here is we've only talked about the accumulation benefit so far, and this is the easiest one. So you're going to have to do this, say, 10,000 times for 10,000 simulations for each policyholder. You could have 300,000 policyholders in your book of business and 10,000 scenarios each. But it doesn't, it's like, an infomercial, but that's not all you get. You also have to calculate the sensitivities of that accumulation benefit liability. And so, again, delta is the sensitivity of the option price with respect to the underlying, which in this case is the account value. So what we need to do is perturb the account value a little bit, and then we're approximating the derivative, as you can see there. So for a small change in account value. So what's going to have to happen there is we've already run this simulation. Now we have to perturb it a little bit and now run 10,000 more scenarios and calculate this price at the perturbed value, take the difference and carry out this division. For gamma, it's going to be the second difference of that, so there's going to be even more simulations to run. And then you have to do the similar for Vega, where this would be a small change in volatility. Rho would be change in interest rates, which we'll talk about in a little bit, and so forth. So now you're running those simulations now multiple times at, say, 10,000 scenarios each for maybe 300,000 miles. I don't know, I suppose a large company might have, that wouldn't be unreasonable, say 300,000 policyholders. Might have different annuity products, but still, that's a lot of computing power that you need.
So when you're talking about running these simulations many thousands of times, is it a way to estimate some of these uncertain values?
No, what you're doing is you're saying, I'm going to simulate a path of equity price movements. Okay.
Mm-hmm.
So once that's done, now once it's generated, you can treat it as deterministic.
Mm-hmm.
Then for this case, all we care about is the last value. So we compare that with the benefit base and take this difference and then the maximum between the two. So that gives us our payoff. Then we have to discount it back, and we have to also decrement it for the policyholder behavior. Okay? That's one scenario. We take 10,000 of those random paths,
Mm-hmm.
so each one is a different realization of equity price movements.
Yep.
From 0 to T. And we calculate that that value for each run, and then we sum them and then take the average.
Mm-hmm.
So that's what we're doing.
Okay.
And that gives you the price of that, essentially the price of that long-term put option.
Gotcha. Because you're simulating movements in
Yeah.
the market.
Mm-hmm.
Okay. Thank you.
How do you account for the changing incentives of the policyholder along the path? So let's say if you're a policyholder, your NAV dropped to 50%. Your incentive at that point is to maximize your risk to try to get back to break even. but that could create an equity, you potentially increase the volatility of that, of your future return stream.
There are various measures of, you know, policyholder behavior functions. What I'm giving you here are just, you know, one very basic one. But there are others, and that's, again, there will be teams that are devoted to that task, usually actuaries, because that's more of things like policyholder behavior would fall under more the actuarial definition. So if it drops really far, what would be the incentive? Can't think of any offhand because they're protected. So I don't know if there'd be any.
We would think they would increase the risk tolerance within the composition of funds.
Well, they're protected from the risk, so they don't.
To get back to zero, but like let's say if you're trading at 80, you bought it on an average down to 80, you have 5 years left.
Mm-hmm.
Hypothetically, I think it's reasonable to expect an investor to go into more risk assets to try.
Oh, I see what you mean, to make up for it, yeah.
Yeah.
Mm-hmm. Yep, that would be a valid thing probably to model.
Mm-hmm.
Yeah, good point. Okay. With respect to interest rates, because we're not dealing with a fixed interest rate, we're dealing with the term structure. So now we're actually going to look at what are called key rates. And so we're going to have to actually calculate rho. We're to shock the yield curve at different points, and then calculate the rho at each one of those points. And so you could have, I don't know, say 10 of these key rates. So now you're up to 10 more simulations in addition to what we've done. And this is only for the accumulation benefit. And on top of that, it's arguably better, rather than to perturb from where you are, it's a better measure actually to perturb in a neighborhood around the point where you currently, where your asset is. So now, in that case, up here we're doing one more set of simulations, here we're doing 2 more. So again, what I'm driving at is you can get an idea of the computing power that's necessary to run these calculations. And getting back to C++, that's why so many of these systems are written in C++, because they've got to be fast, and the reports have to be ready first thing in the morning for when the managers come in. Delta hedging, graphically it looks like this. So the option value, as you see, as the underlying, say again, a simple case stock price goes down, the value of the option goes up. This is the payoff of the option here. And so if this happens, then, as I said, the liability people report these values out. Then the asset team has to take these values, and if there's a shift in delta, then they have to shift their investments to update the hedge. So in this case, they would have to cash out of this position and move into this position. And mainly they use futures, but sometimes they'll use options, but options are a lot more expensive than futures. So futures are the dominant instrument for hedging annuities. Okay. Now for the death benefit liability, I won't go into this in the gory detail I did accumulation benefit, but what we have now though is we need to account for the probability of death before time t, time capital T. So it's the probability of death. It's going to be the probability of surviving out to time t-1 times the probability of dying within t-1 to t. So these are independent, so we just multiply the probabilities. So now this payoff function is decremented by the probability of death. But before, all we cared about was what happened at time capital T. But now this could happen at any time over that scenario. So now, if we look at just one scenario, actually is going to be, we're going to have to take a sum for each time step t, calculate the probability of death, multiply it by the payoff function at time small t, and then discount it back and take this average. But then we have to do it, I actually should have put, this should be 1 over capital T, I apologize. And so this should be, no, I'm sorry. Actually, I don't think that should be there. No, sorry, this 1 over n should be down here, but not up here. So we're just taking this sum, because this is an expected value. So we have to think back to your first probability class with discrete probability distributions. You'd have, say the probability of a fair die. So it's 1/6 for each number. So you have to calculate, and suppose you get the payoff of 1 for 1, 2 for 2. It's the same thing. It's like taking 1 times 1/6, 2 times 1/6, so forth. That's what's going on here. So actually this 1 over n should not be here. This is an expected value of just one run. But we have to do this now capital N times in order to take the average. So now we end up with a double sum. So now the calculations are getting even more intensive. Okay. So further variations, I'll talk about each of these. But time steps are an important concept in this field. To answer your question about multiple funds, so we'll talk about that. So far, we have just taken the market term structure, but we could also bring in stochastic interest rates into our model. But we have to integrate it and take into account the correlations with the movements of the different funds. Also, we could bring in stochastic volatility models. Then other risk measures that we'll talk about. Economic capital, this is kind of like stress testing would be a good way to, you think of Fed stress testing, was the actuarial version of that. And then there's one more thing where it gets even hairier, and this is what's called stochastic on stochastic, or what are called nested scenarios. Okay, but
really quickly, we're a bit over time, so.
I wasn't sure. I wasn't sure if you wanted to. I mean, I can stay if you want, but it's up to you guys.
Yeah, if anyone has to take off, just wanted to say that, please feel free. Yeah, if anyone wants to stick around, I guess we can keep on going for a bit.
Yeah, I didn't know we
yeah,
okay.
apologies there. Yeah.
Yeah, no worries. But yeah, if I'm happy to just take another 15 minutes, maybe.
Sure. Yeah. Or we can also plan to cover part of this next week, depending on what people are feeling like. Is there a way people are waiting? Okay.
I think we got it.
Thank you.
Okay, sure.
It'd be cool if we could ask a couple questions.
Sure. Do you have any questions? Yeah.
Yeah, well, and I've been, because I didn't realize we're up against the clock, so I was just kind of freewheeling.
Apologies there. Yeah.
But yeah,
This is good.
but how about if we just keep going and you can ask me as we go along, and then it'll be recorded, and whoever wants to watch it can watch it. Is that good?
That's cool.
Okay.
Yeah, I have like maybe 15 minutes.
Yeah, it'll be like maybe
Yeah,
15 more
only
minutes.
Okay.
I mean, I've gone through the bulk of it. Getting through that accumulation benefit, you basically see what's going on. Then with the death benefit, it's just it's the same concept, but it's more complex. And now then a few finishing comments here. So, when it comes to time steps, just one thing if you do work in this field, actuaries have different terminologies. So we quants will call these periods annual, semi-annual, and so forth. Actuaries, I'm not making this up, call them anniversaries, semiversaries, quarterversaries, and even monthversaries. So just be warned. Now there is a difference too that between the liabilities side and the asset and hedging side. Is on the liability side, we don't care about the time steps so much. We don't care about day count conventions or anything. We just take this time period and chop it up into even bits. But on the hedging side, you do have to watch out when you're trading because you have to take into account day count conventions. So just something to be aware of.
Day count conventions meaning?
Like actual over 365, 30 over 360, those sorts of things. And settlement dates for futures. Something.
So these would not be stochastic. Would you have to worry about that?
No, we're on the talking on the liability side, so we don't have to worry about day count conventions.
Okay.
But if you're trading, if you're hedging against these values that get reported out, then it's not as simple anymore as just taking this time period and chopping it up. You have to worry about, when you place the date, you place the trade, when it's settled, or with futures, or you have to watch out for the end of the contract because you might want to either roll over or reverse the trade. So it's just with dates, you just have to be careful when you're trading. So,
Is it possible to do these calculations stochastically, like without discretizing? Like, theoretically?
theoretically, yes, but good luck.
Prohibitively expensive.
Well, remember what Brownian motion is. I mean, it's
I'm not
okay.
familiar with that.
Yeah, if you look up Brownian motion, then you'll
It's a
If you-
random motion, completely randomized motion of atoms.
Okay.
Yeah, I think that's where it
That's,
originated.
yeah, I think so, yeah.
Gotcha.
So to get to the question you had about what if you have multiple funds? Okay, the way this is usually done is, so you might, again, like 401k plan, you might have, large cap US, mid cap, small cap, international fund, and then probably some bond funds and maybe a balanced fund or, these different types of funds. Well, and you could have, say, 2 of each type. Well, you can't be exact, so you have to approximate. And what you do is you map these funds to fund types. So you map, say, the large cap US, you would map to, say, the S&P 500 index. You would map any small cap funds to, say, would be Russell 2000, and so forth. And this is important because you have to now take into account correlations between the fund groups. And remember that standard normal term, that random term that we had? When you have multiple funds now, those have to be correlated. And so you have to take the correlations between the fund groups. And then for each fund that the policyholder is in, you're going to have to do another set of scenarios. But you have to use a correlated random variable. So now even more computing resources are necessary. And also policyholders, as I said, have the option of reallocating or automatic rebalancing. And so if you run the risk today and then say next month, some policyholders may have changed their allocations then. So these are things that you have to account for in your models. Okay. What we do here is we just say for the ith fund, it's the same discretization, but this term here now is correlated with the other funds, and that's done with what's called taking the Koleski decomposition of the covariance matrix, and then you multiply it by a set of standard random normal variates, and then they become correlated. And then these liabilities are calculated and then weighted by the weight of each that's allocated to each fund group for a particular policyholder. So again, it's more work that needs to be done in the modeling. We've so far assumed deterministic interest rates taken off the current term structure, but we could use stochastic interest rate models. I don't know if you've seen any of these. Okay, maybe I won't get any, but they're common ones: the Vazicek one-factor and two-factor whole white, and others. And then on top of when you have stochastic interest rates, now you also have to account for the correlations between the interest rates and all the different fund groups. So now you even more work you have to do.
When we're talking about calculating interest rates, are these interest rates determined by, like, when we think about like the Fed or?
It's determined by the market.
Okay.
It's whatever the market's saying.
Interesting.
Okay. But when we mix stochastic interest rates with equity dynamics, these are what are called, and the scenarios in are what are called integrated scenarios. Okay, I won't go through this, but this is what's called the one-factor whole white Black-Scholes model. But this is something that you would get after studying real analysis, measure theory. But this is where the math gets fun. So there's some other popular models for stochastic volatility. These are some of them here. Now, risk measures. You may have heard the term value at risk. Again, actuaries have a different name for this. It's called quantile risk measure. And then in finance, we have what's called ETL or CVAR, and actuaries call this conditional tail expectations. What that is you say, in this case, you say at 80% confidence, there's an amount of money we will lose if the market, in a bad situation. So the lowest 20% of policies, we just take that set, the lowest performing 20%, and then we calculate the expected loss out of just that rather than the entire book of business. And that gives you what's called the CVAR in quant parlance, but actuaries call it conditional tail expectation. Economic capital, what this is up until now we've just assumed what's called the risk neutral measure. But what this does is again, it's like a stress test. And so these scenarios can be determined by corporate standards, industry standards, and regulations. There are a lot of regulations in this area. It's a difference, say, between compared to, say, working as a quant at Goldman Sachs. I mean, yeah, there are regulations, there are financial regulations, but it's, it snows at Goldman Sachs. It's a blizzard at an insurance company. Because you're here, I'll talk about that in a little bit. But anyway, so these are scenarios that actually try to replicate different market scenarios. And so you're stressing your, as I say, you're putting stress on your book of business, and you want to see whether how it holds up and what your risk is under these extreme circumstances. And what economic capital is, by definition, is the capital required to cover risk at a given confidence. Well, more particularly, the available capital to ensure the company will remain solvent for 1 year with 99% probability, which is a typical measure for economic capital. So we want to put in scenarios that are going to stress it till you get to a point that would replicate that situation to see if your company would survive.
Do insurance companies securitize these annuity products and just sell it off to investors?
There was a movement before the crash of 2008, and then it kind of seemed to get put on hold. I don't know where it is now, if that's been revived or not. But yeah, good question. That when I first got in this was 12 years ago, that discussion had just started. So anyway, the economic capital, we replaced the risk neutral scenarios with what are called real world scenarios, which are going to be based on prescribed harsh economic conditions. And also there'll be regime switching, so you'll be going along at, say, one interest rate and then, or some set of assumptions, or, and then there's a shock. In that stochastic term, there will be a shock and cause a downward movement. Yeah.
I would imagine that there's like a fair amount of computational like requirements to go into projecting out economic capital and market conditions.
Yeah, there is. That alone, again, you would need, a lot of that is, as I said, they're determined by regulations and industry standards, but they're companies or sections of consulting companies, again, which that's mainly what they do.
Are there any that you're familiar with?
There's one, they got bought out, there's one called Berry and Hibbert. They got bought out by one of the bigger companies. I can't remember which one. They were good. I met some of their guys. Those guys were sharp. Yeah. So, and then there's what's called stochastic. On stochastic, where you the outer scenarios, you use the economic capital scenarios, and then at time steps within there, then you run on risk neutral. So now you've got these embedded on top of these scenarios. So now you've got a real big computational challenge.
Go ahead.
No, I was just gonna say, I think a couple of us have to take off in just a minute, but did you?
I'm
guys want to
almost
say-
done.
Oh, you're almost done. Okay,
Yeah.
perfect.
So I was just gonna say about working in the business. So just some things to be aware of, that it's a highly regulated environment. Won't go into these, but these are the governing, not just government, but also industry standards. Europe Solvency II, you can look this up, this had a huge impact, and this is why a lot of European insurers got out of the US market, because they didn't want to deal with both the new European regulations and the different set of very strict American regulations. Issuing companies, these are some of the big ones that market variable annuities. There's some low-cost products that are available through Vanguard and Fidelity. Then the supporting actors, these are the consulting firms. Here's Berry and Hibbert, but they got bought out. Investment banks have gotten into the business, and then there's software vendors that have market actuarial and risk software specifically for variable annuities. And I'm not making this up. There's one called Profit and another one called Moses. So, Milliman, their headquarters are here in Seattle. But and they do some really amazing work. Their Chicago office, I've talked with them too, and it's really impressive, the work they do. Computing, here's some of the things that you may see. Monte Carlo, of course, is big, but it's all embarrassingly parallelizable, so you don't have to worry about shared memory, because each scenario is just going to go about its business and not care about what the other one does. Working in the industry, there are several routes. You could be an actuary, you can go in as a quant or as an IT person. So, yeah, with the actuaries, it's a long and just, it's a long, awful slog to get through those exams. There isn't an investment track in the exams, but it doesn't go very deep. And so that's why they bring in quants. But some of the actuaries who take this, it's, they get that designation and, they're like the big man now, right? And along comes some quant with a master's degree. But it turns out that, it's sometimes hard for them to admit that they don't know what these guys know. I'm just speaking from experience. I'm not putting anyone down. I'm just speaking from experience. And then IT is just more the database stuff. I'll tell you a very quick joke. Two actuaries are talking to each other. How can you tell which one is extroverted?
He talks more.
Start the conversation.
No, he's the guy who looks at the other guy's shoes when he talks. So, just some plus sides about working in this industry. It's more stable than working in, say, for an investment bank. You're protected a bit more against financial downturns and so forth. On Wall Street, there'd just be massive layoffs. In insurance, it's more stable. The other side of it is you're not going to get the huge bonuses, although you will do fine. I mean, the money's good. But you can run into spreadsheets from hell, and as I said, some of the turf wars that I mentioned earlier. If you want to work as a quant, these are recognized by the industry. CQF is a big one, and FRM, not so much CFA. If you have a PhD, though, you get some cred. Actuaries have these designations, and that's it.
There are only a couple of us left, but you already have a job, but if you decide to move on, all the firms that recruit with us don't require degrees. So
What's that?
they most, like, a lot of the quants are bachelors, if you're a good mathematician.
Yeah, if you have a PhD in physics or math or applied math,
Different deal.
and if you're Russian, then that gives you.
It's because Russians are better at math.
Again, speaking from experience.